All right. Just wanted to talk about the market today. So there's a lot of things going on. Really what we're seeing is rates, quite honestly, they should be falling and they're not. So we want to unpack as to why and talk about a few other things that we're seeing in the market right now. So really what we want to do is understand kind of what's going on. So if you've only looked at some of the recent economic data, you probably think mortgage rates are improving, but they're not. And that tells you everything about how confused this market is right now. And really, if we're looking at, you know, the averages that we're seeing, the 30-year fixed average that came out from Freddie last week, 6.49, mortgage used dailies index is around 6.64 on Friday, and the 10-year treasury is around 4.57. And of course, this is because of a lot of oil and geopolitical headlines that were feeding into these inflation concerns. So the data is really saying one thing: recent payroll weakness should be good for bonds. The second thing is inflation data has shown some encouraging signs. So normally softer economic data creates a path towards lower rates, but bonds haven't responded the way that most of us in our industry, home buyers, agents, those that work on secondary markets, mortgage-backed securities, of course, originators such as myself and those that run branches. So we keep getting pieces of information that should help mortgage rates, and the market basically shrugs. That's what we're seeing right now, right? So reasons why I think, and what we're really looking at is Iran and oil are overriding everything. Oil jumped again as US Iran tensions escalated. Higher oil creates renewed inflation fears and concerns. Inflation, as I've mentioned so many times before, is the arch enemy of mortgage bonds, mortgage rates. So weaker bonds mean higher mortgage rates. The market's struggling to decide whether it cares more about a slowing economy or another inflation shock like we saw 4 years ago. So my take is very simple on this. Every time bonds look like they want to improve, oil or another geopolitical headline essentially punches them in the face. And it goes back to the Mike Tyson adage. I don't know if you're a boxing fan, but everybody has a plan until they get punched in the face. Is what Tyson used to say, right? So kind of one of those things. I always thought was kind of funny, but it's true. We're expecting these things, and then you get an uppercut. You just get a clean, just right hook. Your face goes sideways a little bit, right? And now we're all like, oh my goodness, what's going on? So rates aren't crashing housing. I want to kind of make that very clear. I know there's been articles saying we're seeing depreciation and we're seeing home values drop and blah, blah, blah. Well, compare it to 2008. Let's do that. Everyone wants to compare it to 2008. Great. Let's look at 2008. Home prices in certain areas, right? Overinflated because of mortgages that should not have been done, appraisers that were affected with that, of course, pushing the sales price. Remember, when they're buying houses, they're buying it for what the property's going to go for, and it was competitive then. Over appreciation. A $500,000 house suddenly became 750 suddenly became a million. These things happened. Now, with that market crash, since most of those loans weren't really worth the paper that they're written on in 2007, 2008, we saw the market crumble. Saw those $1 million properties worth 500,000, in some places 2 to 300,000. In certain Bay Area markets for a single family home. I even know throughout Vallejo a buyer who picked up 14 properties in Vallejo for 100,000 a pop. I helped an agent that's a very good friend of mine that was working as an agent in San Francisco buy 5 homes in Oakland, California for 100 to $200,000. They're all paid off. They rent well now, right? That was that market. This market, different. Again, rates aren't crashing housing, they're freezing it. And affordability is becoming an issue for sure. I'm not going to deny that, but people are still buying houses in markets like San Francisco. We're getting 15 to 20 offers, some of them going twice as much as they're asking on the list price. Come on. We're not seeing the dip in 2008. We're not seeing foreclosure short sale city like we did 2008, 2010. Because if you remember 2008, 2010, we kept saying, oh, there's a shadow inventory if you're working the market. Markets are going to come back. We're going to see these things come back. We're going to see home prices come back. We're going to see, more properties on the market as well. There's going to be more properties, more properties, more. For the last 16 years, we've been saying there's going to be more properties on the market, especially here in California, and we haven't had it. But what we have had is increased demand with a limited supply because there have not been as many homes built as there has been in previous decades. This is 2 decades running now. So I have charts. We've gone over this in the past. If you want, shoot me a message, visit my bio, schedule a call with me. I could go over it in greater detail. But check this out. Home prices, or home properties, should I say, were developed at an exponential amount to meet the demand that was available in that time. We had an oversupply of foreclosed properties, and then the demand was met, and then we were hoping for more properties to hit the market for the last 16 years, and we never got it. So what's that mean? Well, if you can't sell the property for 2 million, but you do have all this equity in it built up from the last 6 to 8 years, it's more than likely that you could still sell the property without having to foreclose or short sale. It means you're not going to see that big dip, right? I mean, it should. So existing home sales are running near a 4 million annual pace. That's big. Sales in the first half of 2026 were only about 0.7 higher than the same period last year. But guess what? Still higher. Buyers are struggling with affordability, as I mentioned. Yes, this is a thing. 100%. There's some programs and things are available. If you want to find out more about those, just get a call. You can visit me on the link below and we'll talk about it. But existing homeowners remain locked into older, lower rates. They have rates that are 2.5%, 3%, some of them, right? And they have 50% or more equity in their property. So there you go. Transactions are still happening because life doesn't stop, right? So again, this isn't 2008. People aren't dumping houses everywhere. A lot of people simply aren't moving. So the biggest opportunity right now, I'm saying, is for loan officers, agents. Stop treating every borrower or home buyer like they need the same loan. Look for things like seller credits, temporary buy downs. Look for opportunities with veterans. We've closed 4 VA home loans in the last 20 days, all within clear to close. I kid you not. We got clear to close all 4 within 7 days. There's opportunities here. There's ways around it. If you're a veteran, want to find out how we're doing it, shoot me a message. If you're an agent, want to find out how we're doing it, shoot me a message. FHA, opportunity. Non-QM, opportunity. Bank statement loans, yes, opportunities. DSCR home loans, non-warrantable condos, bridge financing, buy before you sell strategies, all available. The market is harder. Yeah, in some ways, but that doesn't mean that nobody can buy right now. It just means that often we're seeing, and forgive me for the statement, lazy financing advice is getting exposed. So this is real world. This is really what we want to talk about, what we're doing here at our branch. We're closing within 12 to 14 days. VA purchases gain clear to close in under 10 days. VA purchases under 10 days. Buyers are winning with non-contingent offers when they're structured correctly and they're set up properly. Self-employed borrowers are getting options they didn't realize existed. Agents out there, and I'm finding this because I've gotten quite a few emails over the weekend even, needing lenders who understand guidelines instead of just quoting rates. So waiting for rates to fall is not really a financial strategy. Rates could improve, they could stay elevated, another oil shock could push them higher, and nobody knows. The better strategy is understanding the numbers today and having a plan if rates improve. So, a couple of things. The mortgage market doesn't know what to believe right now. We know that. The economic data says one thing, and oil geopolitics say another. That's why rates are staying stubbornly high. Difficult markets create opportunities for people to understand how to structure transactions. And that's really what I'm watching right now. That's why we're doing so well. Of course, I'm going to have to say it. Yes, I'm recording this. God is blessing what we do. And we're so thankful for yet another year of what we're doing because, we're having another record year. But it's how you strategize these years that's to make all the difference as to what you do. If you want to get a personal session with me, and even if you're a loan officer, Mike, how are we doing what we do? Shoot me a message. I want to help you. I really do. There's a lot of opportunities out there. You just have to seek them out.